Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action. We are seeing all three majors in the green with just 1 hour left to go in the trading day. The Dow up roughly 250 points, the S&P 500 up 18, and the Nasdaq up 33. In terms of sectors that we are watching today, energy and financials seeing the biggest gains, at least in the session. Energy, a big one there on the back of some oil moves, continuing to push higher. Then you see the energy sector up roughly 2%. We are also watching one really big mover today. That is Activision Blizzard, seeing some big gains after a federal judge in San Francisco denied the FTC's motion for a preliminary injunction. We're going to talk about that in just a bit, but that puts the company one step closer to that merger with Microsoft. First, though, investors waiting eagerly for tomorrow's inflation data, with economists looking for more signs of a cool down. But that could complicate things for the Fed when it meets in a few weeks. Let's kick things off with Keith Lerner. He is a co-chief investment officer at Truist. Keith, so let's talk about that big economic data we're expecting tomorrow. What are you looking for in terms of how significant that cool down could look like?
Yeah, well, first, great to be with you. And it is a big inflation print tomorrow. I think part of the reason why the market has rallied is knowing that we would have some disinflationary trends, especially as those base effects from last year come into tax. So listen, the headline consensus is around 3%. If you think about a year ago, we were close to 9%. So we've come a long way. I think it will be favorable overall for the market. But I will say, you know, we're kind of front running that number a bit in this rally that we've seen over the last few days.
Keith, do you think that number, is that going to change anything for the Fed, or does it just reinforce that a rate hike later this month is very likely?
Yeah, I think for July, there has to be something really drastic for them to change. Right now, if you look at the Fed funds futures, basically what the bond market is pricing in, that's at 92%. So they have a green light from the market to raise rates. If you listen to some of the Fed officials over the last several weeks, some of them have been talking about 2 rate hikes. So I think July is most likely. I think as we move past that, I think there's a big question whether we'll actually get another one after that if we see some of these disinflationary trends. And the last point I will say, some of these base effects that really helped during the summer, they become more challenging in the fall. So we'll have to see how that plays out as well. But in the near term, markets focused on, this month and next. And right now, those disinflationary trends seem to be intact.
Well, the big factors that have contributed to inflation, housing, as well as used cars, we have seen a big pullback on that. But, you could argue that that last mile, if you will, to get to that Fed's 2% target is potentially the stickiest one. I mean, how are you looking at that marker there amid a debate about whether, in fact, 2% should be the target for the Fed?
Yeah, listen, I agree with what you said. I think the big picture is moving from 9% down to 3% is probably not easy, but they move rates over 500 basis points. I think getting here is the easier part, getting down to 2% and sustaining that based on the labor force that's still tight. Think about all the onshoring that we have as well, and then some of these fiscal stimulus bills, which are still going to trickle in as far as infrastructure bills. So I think it's going to be a challenge. As far as changing the marker, I don't, there's a lot of back and forth on that. I don't think they're going to change it. I think there's, in their view, and especially Chairman Powell, he's going to continue to talk tough until it's very evident well after the fact that things have come to a level they feel comfortable with. But yeah, I think we're going to be, somewhat of wait and see mode to get to that really at 2% sustained level. Our view is we're likely going to stay at a higher level for longer, somewhere closer to that 3% level.
Well, Keith, the other big thing that investors are going to be watching this week is the start of earnings season. We're going to start hearing from the bigger banks, and Morgan Stanley's Mike Wilson taking a bearish tone heading into the earnings season, saying that results for the second quarter that they can't match up to the stock rally that we've seen. The bar, though, has been set very low. Consensus is for a 9% decline in earnings. If companies are able to beat, is that enough for this market to continue to the upside, or do you share Mike Wilson's stand saying that it's not going to be enough?
Yeah, our point of view is that we're more likely to lead into more of a consolidation. I do share the view that as you think about coming into this earnings season, stocks are closer to a 52-week high. We had a great first half. We've seen, tech or the Nasdaq have its best run since 1983 as far as for the first half. So I think this the way I'm looking at this earnings season is it's going to need to validate the gains that we've seen. I think the earnings season will be fine. I think the economy has been stronger than expectations. I think that will translate into a solid earnings season. But I think more likely is that you're going to see a lot of bifurcation within the market, but the overall headline market, the S&P 500, probably just chop around. If you look back at April during that earnings season, you ran into that as well, and then you chopped around. So I think some backing and filling, some digestion is actually would be a positive, but we're not looking for necessarily a big move down either. We just think it's time to take a little bit of a pause.
To what extent, though, are we likely to see, I mean, if you're expecting more moves to the upside, how are we likely to see these moves broadened out? And we've been talking so much about AI and tech and the run up in that front, but what else are you looking to in terms of sectors that could potentially see more moves to the upside?
Yeah, no, it's a really good question. And it looks to me like big cap tech, which we're still overweight and we think is leadership longer term, because even if the economy slows down, we think that companies will need to invest in technology or fear being left behind. But on a shorter term basis, what we did in early July is we actually boosted our view on the S&P equal weighted index, where every stock in there has the same weighting. And what we've really seen is on a relative basis, we're starting to see improvement even today. What's notable back in June when we upgraded our view of that area is that on a 3-month basis, it had the biggest underperformance relative to the S&P market cap that we've seen over the last 30 years. And that's because of that big cap tech. So everyone was talking about breadth. We are seeing things broaden out as well. So we think that mean reversion towards the equal weighted or the average stock will likely continue, has some more juice. And then outside of that, we also are fans of the industrial sector. Normally, if you still think the economy is going to slow down, you would say, hey, the industrial sector isn't the place to be. But they also have those tailwinds from what I mentioned earlier, that infrastructure spending, that onshoring. And look at the industrials today. They're close to breaking to an all-time high. We think that leadership continues.
So Keith, it sounds like you're seeing some opportunity within individual sectors, but overall, I believe you're still neutral here on this market. What is it going to take in order for you to be on the defensive? Are you going to be more in this wait and see mode until the Fed pauses its rate hikes for the foreseeable future?
Yeah, I know we're strongly neutral, which, as a strategist, a lot of times you want to have a big call either way. But, we're also realistic that this post-pandemic cycle has just been unique in so many different ways. Think about the S&P valuation actually expanded this year, even though the Fed's, still raising rates. So, I think the bar for us to go on offense is relatively high, just because we're trading at a 19 multiple at this point for the S&P 500. Sentiment was depressed, and that helped this market as people, started to add to positions, but less of a support today. And I think the one thing that's holding us back is that we think the policy, as far as fiscal monetary policy, is going to be constrained. So if you think about these big bull markets that we have, 2009 or coming out of the pandemic, you had a huge amount of liquidity coming in because of fiscal and monetary support. We just don't see that today. So, at this point, we're looking below the surface for relative opportunities, but I think the bar is pretty high for us to move to offense at this point. And conversely, if we had a big move up, we'd likely, potentially move back to defense, or if we had a pullback, maybe we'd be more aggressive to the long side.
Yeah, and while we're talking about equities, I wonder how you're looking at the fixed income space. I mean, certainly an argument to be made that if you're getting yields of 4 to 5%, there's more money to be had there. Have you increased your exposure on that front?
Yeah, we're positive. We haven't increased our exposure recently, but I will say one thing that we're more interested in now, we're back to 4%, is we're more comfortable going a little bit longer term in the maturity of the bond. So you look at short-term bonds, you're earning 5 or 6%. But if you look at a 10-year, you're earning 4%. So someone might say, why would I go longer term when the short-term yields are higher? Well, if the economy eventually slows down, then eventually the Fed will have to move lower. And the total return aspect of a 10-year treasury, is attractive and also provides diversification. So at these levels, close to 4%, with some of these disinflationary pressures, with still in our view, all these Fed rate hikes are likely to weigh on the economy somewhat later this year. We think the fixed income market looks more attractive, but we would really focus on high quality, keeping it simple. We don't see much value in the credit sector today.
Okay, some good takeaways there. Truist Chief Market Strategist Keith Lerner, it's good to talk to you today. Appreciate the time.
Great to be with you. Thank you.
Well, Microsoft and Activision Blizzard clearing a big hurdle just days before their merger is scheduled to close. A U.S. judge rejecting the FTC's attempt to block the $69 billion deal. You're seeing the reaction in shares of Activision today, up almost at 10%. Yahoo Finance's Alexis Keenan and Dan Halley joining us now to discuss what exactly this means and the next steps forward for this merger. Alexis, let's start with you, though. Break down exactly what was in today's ruling.
Yeah, so Shauna, what the FTC is hearing here from this federal judge is that it's a no to an injunction request that it had made. The agency wanted this deal to be paused while it continued to review this deal, saying that the July 18th deadline, it should not go forward at that time. But judge not siding with that, and this was a really closely watched decision, and the reason is because it's expected to make or break the broader entire $69 billion deal. Now listen to the way that the judge phrases her ruling here, and this is really important. She says the FTC has not shown it's likely to succeed on its assertion that the combined firm will probably pull Call of Duty from Sony PlayStation. So Activision's Call of Duty game there with a promise from Microsoft that it will not pull it from Sony PlayStation for about 10 years. The judge goes on to say, or that its ownership, Microsoft's ownership of Activision content, will substantially lessen competition in the video game library subscription and cloud gaming market. So a ton of clarity there on how the federal court views this transaction as a whole, because injunctions here are only granted if the judge finds that the moving party, that's the FTC here, is likely to succeed on the underlying case. So just getting so much information here from that ruling. But of course, it's not the end here. The FTC still has its antitrust suit to block the deal going forward, but this certainly opens up the possibility that now Microsoft might be able to start engaging with the FTC in some negotiations now that its position is significantly weakened.
And Dan, we heard from Activision, their spokesperson, coming out with a pretty strongly worded statement saying that the judge's ruling rejects the FTC's ideologically driven attempt to prevent the deal that they say benefits gamers. At the core of this was Microsoft's attempt to expand their portfolio, particularly in mobile gaming as well. I mean, how do you think this hurdle and potentially the closure of this, what does that mean for the sector as a whole?
Yeah, I mean, look, this is something that we're really not sure how this will all shake out. The mobile portion of this for sure is big for Microsoft. They really don't have any kind of skin in the mobile game as far as, the ability to draw users. That's a big portion of this. There's kind of three parts to this deal. There's the Call of Duty aspect, which is a huge franchise. Microsoft said they'll allow it to continue to exist on PlayStation. They've said they'll get it on Nintendo, though the Switch really can't support a game of that caliber at this point, and on NVIDIA's cloud gaming platform. Then there's a cloud gaming aspect, which is part of Microsoft's subscription service, Game Pass. That is something that this deal will help kind of grow over time. And then there's the mobile aspect. And so mobile and cloud gaming kind of go together because when you're on mobile, you can game via the cloud. That's the whole point of cloud gaming, is to be able to play these big name console titles that require tons of power over the cloud on relatively low power devices like smartphones, Chromebooks, your smart TV. And the idea here is for Microsoft to eventually reach gamers throughout the world who don't necessarily have the money to pay for a high-end console or gaming PC, but do have mobile phones and are willing to sign up for a subscription service. So they would be able to get mobile as well as cloud, and that's really where they're kind of angling this. So it's not necessarily about the exclusivity of Call of Duty, or the head of PlayStation had said this is an exclusivity deal that came out in the hearings for the temporary restraining order, but the big deal here is the cloud as well as mobile. And if Microsoft gets this through and they get King, which is part of Activision Blizzard King, they will have a huge stake in mobile gaming going forward. They're the folks that run Candy Crush. So, I mean, you add that with some Call of Duty Mobile, and that's a whole heck of a lot of people.
And Alexis, what about just the consequences for the FTC more broadly when we take into account what they have done under Lina Khan, being very aggressive, trying to rein in large mergers, the fact that they were not successful, at least for now, on this? What does that tell us just about the M&A deals that maybe we could see return to the market ahead?
Yeah, you know, Lena Khan certainly has a very aggressive approach to going after these big tech companies, but a lot of these deals, apples and oranges in terms of how the legal arguments go. But this absolutely shows that the FTC does not have a slam dunk. It must come to court and it must present arguments that show that these alleged antitrust problems are in fact going to be a problem in definitive markets. But look, the FTC also brought this case in its in-house court system. A lot of legal experts tell me that if the FTC was really serious about wanting to challenge this deal, it would have done it in federal court. And on top of all of that, the Supreme Court has not looked very favorably upon the weight of some of these deals that are handled by an administrative judge. That would be this in-house court system. So perhaps the FTC will have to take that into consideration as they go forward with potentially other challenges.
All right, we will see how all of this plays out. Alexis and Dan, thanks so much. Well, let's do a quick check of the market sponsored by Tasty Trade. Let's take a look at the three major averages. We're looking at gains across the board. The Dow up 228 points, S&P holding on to gains, and Nasdaq up about 0.2% ahead of the CPI print tomorrow and earnings season, which gets underway later this week with the big banks starting to report results. Let's also take a look at the VIX. The VIX edging a bit lower today, below 15 at 1487, with just about 45 minutes to go in the trading day. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, Amazon Prime Day is here, but just how important is this sale for the stock price and for Andy Jassy's legacy? We'll discuss on the other side. Plus, shares of Kava are off to a strong start following the company's public debut a couple of weeks ago. But is it enough to reignite the IPO market? And Bill Gates has some major concerns about the future of artificial intelligence and the risks that it could pose to upcoming elections. Much more when Yahoo Finance returns. Amazon is not the only retailer offering massive discounts during Prime Day. Walmart and Target are among the big names slashing prices too, doing everything they can to attract shoppers. And the long list of deals is so extensive that our next guest is calling this week, quote, Christmas in July. We want to bring in Jerry Storch. He's a former vice chairman of Target, also former CEO of Toys R Us. Jerry, it's great to see you. So certainly a massive week here for retail. There's lots of debate going on right now just about the buying power that consumers have. What do you think we'll learn from the deals and from the buying activity that we're seeing during Prime Day and also at some of Amazon's biggest competitors over the next couple of days?
So I think the event will be successful. Amazon is throwing everything at it. They need to show they can generate more growth than what they've shown in the past. So the past few Prime events, just like Amazon sales quarter after quarter, have just been up a little bit, not enough or not consistent with their path growth trajectory. So they're advertising heavily on TV. They're throwing a lot of deals at this thing. They're advertising deals by their partners. They're pushing this very hard to make sure it's successful. I believe it will be successful. And so that means if they sold $12 billion, counting their partner sales last year, maybe it'll be up to $14 or $15 billion this year, which is pretty darn good over the 2 days. Putting that in perspective, that means in those 2 days they'd sell as much in total as maybe, Nordstrom or Kohl's or someone sells their entire business for the whole year. So that sounds great. What we don't know is whether they're just pulling sales forward from later in the year or whether this will be kind of the last gasp of a beleaguered consumer.
Yeah, I mean, that's a good point. When you think about where we are in the year, the offerings themselves from Amazon, they're sort of the usual discounts that you talked about, but also this year they've added travel and partnerships on that front to add to the discounts for Prime Day at a time when we have seen consumers really shell out money on that end, even though they're saving on some of the more discretionary items too. I wonder how you're looking at that balance, the priorities that are shifting right now for the average consumer.
No doubt whatsoever, consumers have been shifting from buying things to services. And you hear that, all the time, from every source. That's true. That is happening. And in fact, when you look at retail sales and take out restaurants for the last 10 straight months, that year-over-year growth has actually been negative when you strip out inflation. So they're not buying things. Now, you often hear they're buying services, and we hear the great stories of how airlines are doing so well, or hotels, for example, or restaurants. And those are up. We are seeing growth there, but it's starting to slow down. Where the real growth in services, when you look at the numbers, is in healthcare services and in paying for rent, which is included in services when you look at a lot of the government reports. So sometimes I think the story isn't being told correctly when they keep saying, the consumer is still spending. Well, you got to pay for healthcare and you got to pay for rent. A lot of healthcare was pent-up demand from the pandemic. There are these categories still. They're not big enough, though, to really, shift the entire economy or consumer spending of travel and dining out. Those are still up. But I think we need to watch them very carefully because you're hearing stories now like occupancy rates in hotels in Florida are down year over year. You're getting these little snippets that don't quite sound as good as they were before.
Well, then, Jerry, given all that, the importance of discounting, of this promotional activity, are we going to see even more of that over the next several months heading into the holidays, given the fact that people don't have that much extra money to spend on some of these discretionary items?
Well, retailers worked very hard to get their inventories down. As you know, many got bloated inventories, at the end of the pandemic when they panic bought, thinking that suppliers wouldn't ship, and then suddenly all the suppliers shipped at once, and inventories surged, and you had retailers that were up, 50% year over year, that kind of number, crazy numbers of inventory, and they worked hard to get those down. So I know people are still trying to be careful, but I don't believe that most retailers have processed just how weak this holiday season could be. Again, I don't know that it will be. It just could be weak. And if the holiday season is weak, we're going to be back in that same thick soup of too much inventory. And the only way through that is going to be through a lot of markdowns, as you mentioned. So I expect to be very tough sledding for a while here. Consumer debt has been mounting. Delinquencies have been rising. I know everyone says, the consumer is still spending. I don't know what they're talking about. Again, keep in mind a lot of these money there, the growth is due to inflation. And then when you strip out some of the necessity services I mentioned, it doesn't look that good all in all.
Jerry, this Prime Day comes at a time when we have seen Amazon's e-commerce business, start to pull back a bit. Sure, it's still relatively strong when you compare it to its competitors, but we have seen the growth flatten out. Is that specific to what we're seeing on the macro front, or are these years of just double-digit, just incredible growth that we have seen from Amazon on the e-commerce front, is that sort of behind us?
Things don't grow into the sky. So I think it's unrealistic to believe that it can start growing again at 25% a year as the numbers that they used to be posting. But I believe they can get out of the single digits and into the low double digits. That's totally doable. And I expect them to do that for these prime days, given how hard they've pushed this and where it's falling in the calendar and how the consumer is acting. There's a lot of values here and necessities. I know my first Amazon Prime purchase that I made just after midnight today, my wife said, "Oh, did you buy a lot of exciting things?" I said, "Yeah, I got a great deal on Advil and Pepcid and, all kinds of cool stuff, a window washing solution." There's a lot of necessities hidden in those Amazon numbers. So I believe it's going to be a tremendous Prime Day for them, and they're going to reverse that trend where they've been growing single digits on Prime Days. You're showing a chart now that shows that. I think they're going to grow double digits during this Prime Day. That doesn't mean we're going to have a great holiday. That's the difference. It might be that they're pulling things. Again, I'm not going to buy any more Pepsi just because I got it on deal. I hope not. Though I'm eating out more, so maybe so. But nevertheless, the reality is that some of this is definitely pulled forward. As a longtime retailer, I can tell you, anytime you have a sale, you can't just study that sale in abstraction. You've held sales off. They've been advertising Prime Day for a week on the site. That means some of the sales people might have been booked for Amazon last week. People were holding off, waiting to see if it went on sale for Prime Day. So there's a suck-in, I call it a suck-in factor and a suck-out factor, where you're sucking goods into the sale and you're sucking sales out of the future and into the sale. And so we have to analyze all of that at the end of the day to see how good it was.
And Jerry, with all of this said, given the fact that it is a very challenging landscape here, more broadly speaking, for retailers, I'm curious, what are you hearing from those within the industry just about the headwinds or the risk that the restart of student loan payments, what that's going to do to some of these businesses and how big of an impact that might have on consumer purchases from here on out?
Most people are worried about it. They just don't know how to quantify it, right? They're not sure, too, what kind of extra steps might be taken. There's all kinds of talks about ways that might extend or defer the impact of that. But most people I speak to view that as yet one more concern for the fall season. Everyone knows it's not good. Where is it going to be worse? Again, discretionary items, apparel, right? And again, purchases of things, things that I don't really have to make. We expect those to be stressed for the holiday season. Everyone knows it, but no one knows how to quantify that impact, and we really aren't going to know until we start getting into the mix of it.
Yeah, a growing list of headwinds for the retail space, but it's certainly good to have your perspective and your context on it. Jerry Storch, thank you so much for joining us today.
My pleasure.
Well, coming up, shares of Kava rising today, despite the gains, though, since going public. Our next guest says you should say goodbye to the restaurant chain. More on that when Yahoo Finance returns. Well, Amazon is rolling out steep discounts during this Prime Day shopping event as it looks to revive its struggling e-commerce business. Online sales in its most recent quarter were flat from a year ago. Yahoo Finance's Ali Garfinkel joining us from an Amazon same-day delivery facility in Gardena, California. Ali, how big of a bump are we expecting Amazon to get?
We'll have to see, Akiko. So I will say, though, that there is a lot going on at this facility. I'm standing currently in the dispatch area, which is the last spot your packages are before they head off to your house. For instance, I ordered some ground saffron last night. I know, super bougie, but it's the sort of thing where I ordered that last night. It's standing back there and it's heading out the door. Over the course of the next 2 days, about 120,000 packages are going to move through this area right here. And it's where I think one of the sort of central questions of Amazon Prime Day really plays out. How is the consumer doing? What are they buying? And I think this is incredibly important to consider, especially in the context of not only a difficult macroeconomic environment where consumers are more cautious about spending, but in the context of increased competition. Remember, there's something that we've come to know as the Prime Day halo effect, where shoppers start looking for deals at Prime Day and then they cycle through to other big box retailers. For example, Walmart, Target, Best Buy, all of them have competing sales around this time where consumers start at Prime Day and end at Best Buy. In short, what I'd say is we don't know what kind of bump we're going to see. However, I can tell you one thing for sure. Prime Day isn't just about Amazon anymore. It's definitely not just about Prime Day itself.
Ali Garfinkel with a roundup of Prime Day. Thanks so much for that.
Well, stocks edging higher as traders count down to the next inflation report. But with earnings season just around the corner, we're taking a look at some stocks to consider buying and some to avoid. Here to discuss, we want to bring in New Construct's CEO, David Traynor. David, it's great to see you again. I want to start with one of your sell picks, and that's Kava. And just a couple of weeks ago, or several weeks ago, I should say, we got your thoughts on the company before it went public. I want to play real quick what you had to say then about Kava.
We think Kava is the next WeWork. We don't think this IPO should actually ever happen. This is a ruse to trick unsuspecting retail investors into buying what is a terrible business. It's burning cash flow. Its cash flow is only going to get worse. And we think the only reason this company is deciding to IPO in this environment, because if they can't get an IPO done now, they never will, because the cash flow burn is going to get even worse.
David, investors, though, have been interested in the name. The stock is still at just around double its IPO price. I'm guessing you haven't changed your stance. Why?
No, I mean, this is just sort of almost a replay of the IPOs from 2021 that came out and doubled, and then soon thereafter fell 90+%. Look, the valuation implies that the company's margins will go from very negative today to where Chipotle's margins are and grow at the same time, grow at 25% compounded annually for the next 10 years. That's about what the company has to do to justify $45 a share. And by the way, Chipotle didn't even grow at 25% compounded annually for its first 10 years. It only did around 22%. So this is priced to be bigger and better and more profitable than Chipotle. And so, I mean, what can I say? All the good news is priced in, and in the backdrop of the fact that it's burning a lot of cash. They needed this IPO to keep from going bankrupt. I guess I'll stop there.
Well, David, I mean, what does that tell you, though, about where this current market is? If we're seeing investors chasing a stock that you say is basically bleeding money, not on the track to profitability, what does that tell you about where the mindset is?
Oh, I mean, I think it's pretty clear we're in a risk-off kind of mindset. I mean, we're chasing NVIDIA up, huge amounts, and a lot of junk stocks, meme stocks have been flying, Rivian's flying. Look, there's a lot of liquidity. There's a lot of federal stimulus, trillions of dollars of federal stimulus that had been poured into this economy since COVID. And a lot of that's just flowed straight into speculative trading. And that spells bad news for investors who, don't really know how to time it. And look, I don't like to pretend that timing is a good strategy at all. I just here to be, to recognize that obviously the stock's gone up a lot, and if you were in it early, you've done well. The question is, when will it come back to earth? And I don't want to be around when it does.
Well, David, another name that investors have been chasing since the start of this year is Uber. We've seen the stock rise just about 80% since the start of January. You're still not sold on this name. You're actually naming it as one of your zombie stock picks. Why don't you see maybe a more optimistic outlook here, given some of the improvement that Uber has seen over the last several months?
Yeah, no, look, I mean, I'm not going to say that the business isn't getting better, but you have to reconcile that with what the valuation says about what the business will do, right? So our approach is to use a reverse discounted cash flow model that quantifies the future performance needed to justify the stock price. So we can say, okay, well, if $45 for Uber means that the company's got to go from a negative 5% margin to positive 5%, while simultaneously growing revenues at 35% compounded annually for a decade, that's probably fully, pretty expensive, right? And that would imply that Uber's share of the rideshare market would be something like over 100% at that kind of revenue growth rate. So, the valuation just doesn't make sense. This is not to say that Uber is a bad business. It's not a great business. It's cash flow burning, has been for a long time, which is why it's a zombie stock. But even if something is a good business, that doesn't mean it's a good stock.
Let's talk about stocks that you do like. Arguably less sexy names, right? We're not talking about Kava and Uber, but Discover Financial Services. What do you like there?
Great underwriting, very cheap valuation. When we first named that to our long idea list, I think the stock price implied that profits were gonna decline by 50%. Notice the nice juxtaposition, right? Profits for Kava and Uber are expected to climb astronomically. Discover's price today still as if profits will decline by 40% permanently. So, really nice, cheap valuation with very strong cash flow. Again, different from Uber and Kava. Discover's actually generating real cash flow, and they've got great underwriting. So their loan losses and delinquencies are looking better than peers. So we think that the cash flow is going to continue. And if the stock price recognizes that, there's a lot of upside.
Another name that you do see upside with is HCA Healthcare. Lay out the bull case there.
Look, it's a very defensive industry. And HCA is one of the most profitable and successful hospital chains in America. Demand for services are still growing. It's been able to adapt and maintain a higher return on invested capital than its peers. And we still like the valuation. It's gotten a little rich on us here, but because it's been a great performer since it's been on our long idea list. And so it's one of the just better stocks out there. Again, generating a huge amount of cash flow, reasonable valuation, strong long-term demand and tailwinds. We think it's a much better stock to be in, of course, than Uber and Kava.
New Construct CEO David Traynor, it's always good to get your perspective here. Appreciate your time today.
Thank you. Thank you.
Car dealers appear increasingly concerned over GM's decision to phase out smartphone mirroring software like CarPlay from its vehicles. Yahoo Finance's Pras Subramanian has this story for us. And Pras, why are we seeing some concern here over the move that we knew was coming from GM?
Yeah, well, I guess now we're hearing that some dealers are kind of concerned that buyers may balk at GM products here, because what GM wants to do is they want to introduce their new kind of infotainment system in their newest EV, starting with the Blazer EV coming out this fall. So the Detroit Free Press spoke to some dealers, and they talk about how if CarPlay ain't broke, why are you fixing it? Why are we doing this? Why are we kind of making this big change for these new products coming out that are a big deal compared to the Ford Mustang Mach-E and cars like that, Kia EV6s of the world? There's a big concern there as this change happening. Why are they making these changes with a very popular product? I mean, Apple says that about 80% of users want CarPlay in their car. Consumer Reports says it's more around 55-60% of users love CarPlay. They don't want to not have it. So this is kind of a conundrum for GM as to why they're doing it. I mean, we get it, why it's because they want to get to add-on subscription fees, new services, new data they can get in versus giving it up to Apple. So that's sort of why they're doing it, but it might backfire on them.
And Pras, you've written about this before, about these additional sources of revenue, specifically look at subscription models. I mean, how does GM's action stack up against what we've seen from some of their other competitors?
So, we spoke to Ford at their Capital Markets Day, and they're talking about making a software-defined vehicle, one that kind of runs on one single OS, and they can of course then update via over-the-air updates. They can add apps to it that people will actually subscribe to. So it's not unheard of. But what Ford's not doing is getting rid of CarPlay. The Ford CEO Jim Farley said that our users want CarPlay. We're not going to get rid of it. We can't do better than what Apple's doing. So they're going to keep that. And competitors like Kia, Hyundai's of the world, they all are sticking with CarPlay. Mercedes, BMW, also with CarPlay. So you can see that GM is potentially out there on an island along with Tesla and Rivian, but those two actually have a more developed ecosystem for their EV products.
See whether or not it hurts sales of the GM vehicles here coming up right, Prost. Thanks. Well, coming up, while the IPO market is showing signs of life thanks to Kava, some say that the environment will be challenging for the next several quarters. We will discuss the second half outlook for the initial public offerings on the other side. Stick around.
I'm really fired up for earnings season to start too. We have bank earnings on Friday, and then you also have Delta reporting on Thursday, and Pepsi also expected to report on Thursday. But I think a key theme when you think about this week is really what have the interest rate hikes started to do to the economy.
I could see some earnings weakness across the board. I think you're going to see a little bit of tentativeness from companies about consumers. I think it's going to be this story about the US consumer, what's going on there, and global growth. Go back, say, 6 months to a year. If you talked about your supply chains being okay, that was enough. Now it's not about supply chains. It's now, are you able to sell your products, and at what margin are you able to sell those products?
there is not going to be any year-over-year sales growth for the S&P 500. That would be the first time that has happened in the past 10 quarters. So not every company's like NVIDIA. Not everybody's selling AI chips.
Goldman Sachs is saying now the key areas that investors will be watching for is maintaining margins, trying to push sales for profits, the impact of bank stresses and credit lending, the potential uses of AI, and also the health of the consumer, how much the consumer is willing to spend.
When all of these companies more broadly talk about earnings, especially within that airline travel experience, we're marching towards some of those key time frames for a company in Delta and many of the others and trying to get back to that full capacity. We've heard from Ed Bastian time and time again that this is the year.
If we look at big banks and even the broader financial sector, they haven't really participated as much in the year-to-date rally, with earnings kind of expectations already being low. The sector we like, it's a sector we've been overweight most of the year.
I think it's going to be, not banks' finest hour in terms of earnings this quarter. Clearly, the higher rate environment that was very helpful in 2022 for net interest margins is having a detrimental effect now. You've got slowing loan growth, just less demand as you have much higher interest rates here, and that's the intended effect of the Federal Reserve.
The nuclear power startup backed by OpenAI CEO Sam Altman is going public via a SPAC. The company Oklo, valued at nearly $1 billion. Jared Blickery is at the New York Stock Exchange with a closer look at the state of the IPO market and the performance of SPACs. And we'll see whether or not Oklo is really going to test, I guess, investor appetite for SPACs, which we know have fallen out of favor now for quite some time.
Yes, Shauna. Oklo coming to market is a really special deal, not only because it's a SPAC, but because the target company is affiliated with the original company that raised the money. So that would be Sam Altman. He is one of the founders of both. And of course, he's better known for OpenAI, founder there, and the ChatGPT that has captured headlines and imaginations, including mine. But I digress. Let's go to the Wi-Fi Interactive because I have some interesting stats on the entire market. Then we'll go back to Sam Altman's deal here. But we're sitting on about 1,200 deals, and the total size of the U.S. SPAC market is about $310 billion. You'll notice about half of those, $138 billion, those are still seeking a target. And that's a problem because a lot of these companies were raising money 2 years ago, or just beginning in 2 years ago in 2021. They have 18 to 24 months, sometimes a little bit longer, to find a deal. They're running up against that deadline. They don't find it. Investors want their money. Well, investors have to get their money back. And in addition, some investors have been clawing back their money anyway, leaving some of the deals in limbo. And of the deals, 324 are completed. That's about $92 billion. That's 3 out of 10, I would say. 30% is not a big number. 45 billion have been liquidated. That is a huge amount. Those are absolute failures. That means that the company could not find a target company to finally come to market with to list. Pending, that would be including Sam Altman's deal, that's about $30 billion. So altogether, this is really a market that has been decimated. Now, I'll go back to Sam Altman's deal right here, and I'm going to show you the entire price history. This came to market at $10 a share. You can see it's at $10.39. It's fluctuated above and below, but pretty much in a narrow band there. And indeed, we're knocking on the door. He's knocking on the door of that 24-month, 2-year time limit. So time is of the essence, and you can imagine a lot of these companies wanting to come to market now because the market was so not only decimated, obliterated last year. There was no IPO market that was functioning last year. A previous guest brought up Kava Group. I'm just going to show you a quick chart of that. They came to market only a few weeks ago. I was here at the New York Stock Exchange. It was a big production. Most people I've probably seen here in years. This is an IPO that was very successful, at least by the technicals. Came to market at $22 a share. That's what they sold to investors. Now trading at $45. And you can see, just a few days ago, it actually undercut its opening day price. So IPOs can be rather tricky to trade here. SPACs a little bit more tricky, and we're going to have to see how this one shakes out. But there's definitely going to be coming a lot more deals going to be coming to the market this year.
All right. Jared Blickery, thanks so much for the latest from the floor of the New York Stock Exchange.
Well, the early success of Kava potentially showing the IP market could be coming back to life. Our next guest says it takes more than a listing day pop to instill confidence in the market. Let's welcome in Seth Rubin, Stifel Head of Equity Capital Markets. Seth, I was looking through the numbers for Q2, 23 IPOs raising a combined $6.6 billion. That's a pickup from where we were the previous quarter, the year before. Can we continue this momentum going into the second half of the year?
Yeah, thanks. I do think so. I think there's good reason to see some enthusiasm, and there's good reason for some optimism of the market. As you said, Q2 was actually the best quarter we've had in the IPO market since the last quarter of 2021. I think you have to take a step back and remember that in the last quarter of 2021, we had free money. We had a growth at all cost environment where people were willing to just continue to plow into money losing companies to show some growth that was beating the market, and we had peak valuations. And so none of those things exist anymore, and we've started to see some return to investor appetite for buying the new issue market, and in particular IPOs. But I think as your last host said, we're a long way from normal. We're still very much in a rebuilding mode, and we've got to make sure that the deals are set up to succeed.
Seth, in terms of what investors are favoring in this environment, given the fact that there is so much uncertainty, and we certainly have seen an uneven sort of, I guess, a huge gap in terms of the first or couple week performance that we have seen of these companies that recently went public. When you take into account Kodiak Gas Services, what that looked like, to what we saw with Kava, a very different picture. What are investors favoring in this environment?
Yeah, look, I think it's hard to just look over the last couple of deals or even the last couple of quarters and say that's the trend, right? Because there have been so few deals that investors are still trying to get their heads around what are these trends and how do we think about pricing and what's the right entry point for companies. But we spend a lot of time with the buy side. And I think what you'll hear is pretty consistent, which is they want companies that are at scale. They want companies that have profitable unit economics, so they see a real pathway to profit, to driving profits and to driving earnings. They want growth, and they want real visibility in the market. And they want to be able to get all that at a reasonable valuation, right? So I think you put those things together, and what it's going to say is you can find pockets of that within every sector right now if you can find the right companies and you can get them out at the right time.
If that's the case, how do you explain the kind of pop that we see in Kava? That's not a profitable company.
Yeah. So I think the things that were attractive about Kava, and I don't really want to talk about any specific companies, were really the growth in the unit economics, and that investors really believe that with an execution story there, you're driving to profitability and you're outgrowing the market. And within consumer, I think if you can come to the market with something that has real scarcity value and can become a market leader, there is a desire to own that, right? There's supply demand economics, and people want to own that. I think if you look across other sectors, you'd say if you went back this year, it's not the sexiest, sectors that we typically think about, right? There were a number of deals in insurance, specialty insurance. You said energy, oil and gas, some of the other sectors that when you see some of the high flying companies, you don't pay as much attention to. I think we're in the process now of testing the market. When can we bring back companies that can get paid on a forward growth multiple? And how far in advance are people willing to lean into that? And so I think we're going to see strength in technology with the AI and the super cycles that are driving sort of new innovation coming to the market. I think we're going to see it in biotech, where the science is improving at rates that we've never seen before, and the crossover investors are really driving some additional capital into that market. And I think we're going to continue to see it in consumer. But again, this is not a one sector fits all. This is really a company by company analysis, I think, for a period of time.
Well, Seth, what do you think is necessary for the IPO market then to fully open?
Yeah. So I think it's going to take some time. I think it's going to be, frankly, cohort by cohort, where you see deals succeed over not just the first day. I mean, first day pop, of course, is important. It gets a lot of media attention and focus, and deals have to work, right? They can't break down right away. But I think what investors are looking for is this sustainable? Are you 1 quarter, 2 quarter out? Are companies meeting and beating the expectations that they set with the buy side at the beginning? I think slowly that's going to give investors confidence that they can start to be involved in more transactions. Right now, people want to invest where they have a relationship with management, they've spent time, they've done the work, and so they're going to be very selective for a period of time. So my personal view is why we will absolutely have some IPO activity in the back half of the year. I think it'll be more than the first half of the year. It'll be more than 2022. It's going to take us another couple of quarters to really rebuild the IPO pipeline to what has been more sustainable historically.
Seth, what about SPACs? I mean, are we going to continue to see companies still utilize that as a potential tool to come to markets? Maybe not at the level that we saw several years ago, or you think that given how companies that have come to market through blank check companies have performed, that's kind of behind us?
Yeah, I think we're going to see, obviously we won't see the same activity that we saw in 2020, 2021, even the beginning of 2022. I think, frankly, as the IPO market picks up and as you see more capital going in the market, you'll start to see more SPAC exits as well. So I think if you go back to what a SPAC was really made for, which was the ability to bring a company public that maybe had some story behind it or something that was different from a regular way IPO, but that company still was ready to be a public company. So I think to get SPAC deals done today, and they absolutely will get done, and we've been very active in the market, it will be with companies that really are ready to be public companies, right? They've been performing like a public company. They have scale. They have real governance. They've got the ability to provide investors and research analysts visibility, and they can perform over time. So those things are going to bring deals back to the SPAC market as well. But again, just like the IPO market, it is not going to be any size fits all, and it's not going to be a market where we say we'll pay for growth in perpetuity without the ability to drive unit economics.
It'll be interesting to see how things pick up in the second half of the year. Seth, good to talk to you today. Seth Rubin, Stifel Head of Equity Capital Market.
Good to see you. Thanks.
Well, coming up, the closing bell on Wall Street. We're going to check in on the latest market moves and the top trending tickers. Stay tuned.
That's the closing bell on Wall Street. Let's do a check of the markets sponsored by Tasty Trade. All three of the major averages ending to the upside ahead of tomorrow's inflation print before the bell. We're looking at the Dow closing up just around 300 points. The S&P up about 0.7%, and the Nasdaq also adding to gains, up about 0.5%. Taking a look at some of the individual movers of the day. First up, Roku. Shares are surging as the company teams up with Shopify. Now, Roku users will be able to buy products from Shopify merchants directly through Roku TVs. We're looking at gains of just about 11% here for Roku, Kiko, the biggest gain that we've seen for the company in just over a month. And I was taking a look at some of the reaction that we're starting to get to trickle in from analysts covering Roku, and Steven's analyst saying that Roku is now well positioned and in a leadership position in connected TV's operating system in the U.S., given this strategic partnership with Shopify.
Yeah, I mean, being able to shop from your couch seems like a good
So
bet,
nice.
right? I mean, dangerous maybe, but I mean, you know, some have been quick to argue that this has been tried before. The Home Shopping Network had kind of a testing round specifically with this, but the Roku Shopify partnership, and given just Shopify's reach, certainly a reason to get excited, at least for investors. And you see Roku shares are up more than 10%. Beyond Meat announcing its plans to expand the retail availability of its plant-based product, Beyond Steak. The company expects to bring this into a slew of new stores, including Whole Foods Market and Wegmans. Shares getting a lift in today's trading session. That stock up more than 4% there. Shauna, you know, I keep going back to a number in terms of what this all means for Beyond Meat, and that is the sales of plant-based meat, down 28 consecutive months. So beef or steak, certainly very exciting. The reach really points to the opportunity, but you have to wonder if that sector has particularly peaked, regardless of what kind of alternative meat we're talking about.
Yeah, and I think that's largely been the consensus, at least amongst investors more recently. We have certainly seen more short interest on this stock, given the fact that the company has been struggling to really expand its market share, expand its presence within this category. And more broadly speaking, like you were just saying, Akiko, I think investors' appetite here for this category has soured just a little bit, just in terms of some questions about what that growth trajectory is going to look like. We just had the chart up there. We're well off at 90% from the peak right now. We know Beyond Meat has gone through multiple rounds of layoffs just within this past year, trying to cut costs, trying to better position the company moving forward. But at least up until now, the demand is just not there. All right, well, Zillow shares closing the trading day higher after Piper Sandler upgrading the stock to overweight from neutral. The firm citing confidence in the future of the housing market, also the ability for Zillow to account for more of the homes that are being put up for sale in the housing market as people do sort of start to favor a more digital type of option. And we know Zillow is one of the leaders here within the tech real estate marketplace. So again, Piper Sandler seeing some room to run here with shares popping just about 9% today, Akiko.
Yeah, I mean, that's significant upside when you think they upped their price target from $42 to $62. A number of things here as we look at the housing market broadly. The analyst Thomas Champion saying specifically a decline in home sales likely to have hit a bottom in the last quarter. Mortgage rates have started to stabilize. And then if it's specific to Zillow, he sees a real opportunity here through the premier agent offering there. So interesting to see how that is in relation to where we've been watching the housing market, which has kind of been really leading indicator of where the Fed policy has been moving.
It certainly has been. All right, let's take a look at JetBlue ending the trading day lower, off just about 2.5%. The move coming after a downgrade to underweight by analysts there at Evercore. Yahoo Finance's Inez Ferre has been digging into this call for us. And Inez, what's the downside risk here from Evercore?
Yeah, that's right. Well, Evercore keeping its price target of $8 a share for JetBlue, but as you mentioned, downgrading the stock to underweight from in line, basically with some harsh commentary inside that note, that analyst note saying JetBlue's balance sheet is on a journey from average to worst in U.S. industry. Talking about JetBlue recently losing that Northeast alliance with American, a federal judge had ordered JetBlue and American to untie their partnership, ruling that it violated antitrust laws, that it created fare hikes, that it created less routes. And also talking about the merger, the pending merger with Spirit, that $3.7 billion deal. And these analysts are saying, while there are twists and turns, we do think that that Spirit acquisition will ultimately get done, while the premium that JetBlue is paying for Spirit continues to expand. Talking about how travel has come back, but when it comes to Spirit, these analysts are saying that the 23 consensus for earnings per share for Spirit has moderated from $3.48 2 years ago to around 30 cents currently, keeping in mind that travel demand has come back.
Looking ahead to later this week, Inez, what can we expect from Delta's second quarter earnings?
Yeah, well, it's interesting because these Evercore ISI analysts have Delta as a top pick. There are actually 20 buys on the stock, 1 hold. And Delta is expected to report record profits for the second quarter to come in at $2.41 a share, revenue to come in at $14.4 billion. And that profit is expected to be so high because of the pricing power that these airlines have had, lower fuel costs, and the investor day that Delta had recently talking about their initiatives there. The lower fuel costs have really had a benefit when it comes to the airlines, especially when you're talking about the labor costs, which have gone higher because Delta recently had announced a pilot agreement. Keep in mind also, American had recently increased its guidance because of that lower fuel cost. And if you take a look at the performance of these airlines, I'm pulling up the Wi-Fi Interactive right now, and you can see the travel stocks. Those are all higher year to date. You are being led. The ones that have gained the most, yes, are the cruise line operators, but that's closely followed by the airlines. Delta up 48% year to date. You've got UAL up 49%, American 47% higher, guys.
Yeah, certainly have seen consumers shifting their spending patterns and willing to spend, at least for now, on experiences and on travel. All right, Inez Frey, thanks so much.
Thank you. Well, NATO members coming out with a big statement on agreeing to pull Ukraine closer to joining the security alliance, but it offered no specific timeline for membership. Let's bring in Yahoo Finance's Rick Newman. Rick, the lack of timeline really got a very strong response from Ukrainian President Vladimir Zelensky, who called it unprecedented and absurd.
He's saying, speaking his mind there, it's definitely a disappointment for Ukraine. What Ukraine wanted was not immediate ascension into NATO. Nobody thought that was going to happen. But they wanted a timeline that was spelled out, that, with conditions such as once there's a ceasefire with Russia, or once the war is over, or something like that. Instead, it's just kind of a vague statement that NATO will consider Ukraine as a member when the time is right. All is not lost for Ukraine here. There still are some things going Ukraine's way. France just said they are going to give Ukraine some longer range missiles, which Ukraine has been begging for. It looks like they might get some F-16s this year. And, the way this works with NATO, it takes time. You're talking about, 31 countries now that Sweden is in, agreeing on something. And each one of these countries, the leaders of each one of these countries, has domestic political concerns. President Biden himself has said this is not quite the time for Ukraine, and America is the de facto leader of NATO. So not happening now, but it's not stopping either. They will keep working on it.
Rick, how much of this is just about the obligation that comes with NATO membership? If Ukraine becomes a member now during the war, that would inevitably pull in members into the war itself.
That is so. Experts on the NATO and the NATO Charter say that is not really true. So it's not as if an agreement to admit Ukraine. And again, we're talking about in the future. We're not talking about this happening this year, that would somehow obligate all the other NATO nations to actually put boots on the ground in Ukraine. I think that's a red herring. What's more interesting here is what message it sends to Russian President Vladimir Putin. So this is what Putin would want. And one reason that the United States and some other members of NATO don't want to give Ukraine such a clear pathway in just yet is this old concern that this would be a provocation to Vladimir Putin. So people who are more hardline about this are saying, come on already. I mean, look, Putin has backed down from one red line after another, and surely you can't worry about confronting him on this. But look, it's incremental. President Biden has broadly taken an incrementalist approach to this war, give Ukraine enough to survive, see how it does, then give it some more in terms of weapons and other types of aid. And I think that's the way it's going to go for NATO membership. So maybe this time next year, it'll look more promising for Ukraine joining NATO.
And Rick, you talk about aid, members of NATO really upping the aid to Ukraine. The U.S. specifically, the Biden administration has greenlit essentially these cluster bombs, which have really faced some opposition among lawmakers as well. I mean, what does that path look like? And put that in context for us, why that is such a concern.
The cluster munitions are going to Ukraine. That decision has been made, even though it's getting some pushback. So I listened, I'm paying a lot of attention to what's happening on the ground in Ukraine, and I listened to these arguments about why Ukraine should not use these. The short story here is the problem with cluster munitions is they leave a lot of unexploded ordnance behind. So once the war is over, these are deadly to civilians, but that's after the war is over. I mean, the most objectionable use of these things are when you are bombing somebody else's country. So Russia has used cluster munitions in Ukraine. Ukraine would be using them in its own country, which would give them a very powerful incentive to do the absolute best possible job, to do things like track where they use them, know where they are, so that once we ever get to the point of cleanup, they can go and clean them up. So make sure they're not dangerous to civilians. But they'd be using them in areas where there are no civilians because the Russians have militarily taken over these areas, and Ukraine is running out of other munitions. So this would be for Ukraine to use in lieu of artillery shells, which they're running short of. Which, let's remember, Ukraine is just getting started on this so-called counteroffensive to try to make some kind of breakthrough here. You can't micromanage an ally like this and say you can use these weapons but not this. I mean, it really does seem like they're going to be using it on their own territory. You have to let them make the decision about whether to use it, and they say they need them, so they're going.
Rick Newman, as always, giving us that context. Thanks so much for that.
Bye.
Well, coming up, Bill Gates issuing a new warning about artificial intelligence. The argument coming from a new op-ed we're going to discuss on the other side.
I'm really fired up for earnings season to start too. We have bank earnings on Friday, and then you also have Delta reporting on Thursday, and Pepsi also expected to report on Thursday. But I think a key theme when you think about this week is really what have the interest rate hikes started to do to the economy?
I could see some earnings weakness across the board. I think you're going to see a little bit of tentativeness from companies about consumers. I think it's going to be this story about the U.S. consumer, what's going on there, and global growth. Go back, say, 6 months to a year. If you talked about your supply chains being okay, that was enough. Now it's not about supply chains. It's now, are you able to sell your products, and at what margin are you able to sell those products?
There is not going to be any year-over-year sales growth for the S&P 500. That would be the first time that has happened in the past 10 quarters. So not every company's like NVIDIA. Not everybody's selling AI chips.
Goldman Sachs is saying now the key areas that investors will be watching for is maintaining margins, trying to push sales for profits, the impact of bank stresses and credit lending, the potential uses of AI, and also the health of the consumer, how much the consumer is willing to spend.
When all of these companies more broadly talk about earnings, especially within that airline travel experience, we're marching towards some of those key time frames for a company in Delta and many of the others in trying to get back to that full capacity. We've heard from Ed Bastian time and time again that this is the year.
If we look at big banks and even the broader financial sector, they haven't really participated as much in the year-to-date rally, with earnings kind of expectations already being low. The sector we like, it's a sector we've been overweight most of the year.
I think it's going to be, not banks' finest hour in terms of earnings this quarter. Clearly, the higher rate environment that was very helpful in 2022 for net interest margins is having a detrimental effect now. You've got slowing loan growth, just less demand as you have much higher interest rates here, and that's the intended effect of the Federal Reserve.
Microsoft co-founder Bill Gates releasing an op-ed today voicing his concerns over the future of artificial intelligence, saying that the risks of AI are real but manageable. Yahoo Finance's Dan Halley joining us now for more on this. And Dan, I know you've been digging into this op-ed, but one of the warnings that he's focusing on this time is how AI could potentially influence the elections, upcoming elections worldwide, and what exactly that fallout could look like.
That's right, Shauna. This is an op-ed where Bill Gates basically says, there's fear but solutions. So let's just go over his warnings for first of all. He does talk about the broader existential threat of AI. People have brought this up before, that it could, should we develop AI that can replace people, things along those lines. But he focuses more on the real problems that we're facing right now. And as you said, chief among them are potential disinformation and misinformation ahead of elections and during election season. He also goes over the fact that it's easier to launch attacks on people and governments. As far as that disinformation and misinformation side of things goes, he also talks about people's jobs. While this isn't necessarily the Terminator, AI is going to be the end of us all discussion, it is a discussion as to the fact that there are, frankly, some jobs that will be replaced by AI, and this is something that needs to be studied and looked at more closely. He also talks about the inherent biases we see with AI. These are created using algorithms by people, and people's own biases, whether intentional or not, go into these algorithms, and that's how we get certain outputs, denying people loans or keeping people from getting jobs, things along those lines. Then there's also the idea that AI, ChatGPT, generative AI, will be abused by students in schools, and that those then will become a way for them to more or less cheat down the line.
So there are concerns out there, but it's not all negative. What are some reasons that he's optimistic about AI?
Yeah, so while he does go over these kinds of fears, he does couch them. And look, we've seen this kind of disruption before, right? He goes over the internet, even the car, how that changed people's lives. And he says that this isn't going to be akin to the Industrial Revolution, but it will see changes. So, when it comes to that disinformation and misinformation, altered photos, altered voices, things like that, he says that while generative AI can do that, there's also AI that can detect that. So it's not necessarily a one-way street. He also goes over the fact that there will be job losses and says that, look, this is something the government needs to work on to ensure that folks aren't left behind and that they're able to be to learn new skills and work in this world. It's also worth pointing out that others have said that AI will open up new jobs. So not necessarily just be an end-to-end job killer, but bring new jobs about. When it comes to those biases, he says that this is something that government also needs to look at, and that the kinds of algorithms that are put out there need to be studied more closely. And then finally, as far as when students having trouble learning or using this as a way to get around learning, he said, look, that was something that the calculator was being accused of when that first came out, as well as the internet in general. Look, I'm not going to lie. I may or may not have cribbed some notes from the internet to write a paper in middle school. I'm not, going to admit to that. I don't know what the statute of limitations is, but that's kind of what he's going on over here. That it's not necessarily, just a negative or a positive. It's going to be a mix, and there are ways to deal with this before there are past precedents that can be applied.
Important issues there brought up by Bill Gates. And Dan, you're not alone. I think it's safe to say at this point, we're 20 years removed from this. We can talk about the fact that we did use the internet to help us a little bit in school growing up, right, Dan? Thanks so much. Let's do a check of the market sponsored by Tasty Trade. Again, you looked at gains across the board for the day. The Dow closing up just over 300 points. One of the top performers in the Dow today, Salesforce, closing up just about 4% on the heels of an announcement that they do plan to raise prices. S&P up about 0.7%. The Nasdaq also closing in the green today.
A new report highlighting the state of real estate in New York City. Prices edging down in the second quarter compared to a year ago, but they're still hovering near record highs. Joining us now is Francis Katzen, founder of the Katzen team at Douglas Elliman. Good to talk to you today. So there's some positive in here, some stability, hovering near record levels. What's holding the market?
Cash and people wanting to take an opportunity to get in while there's a capitulation in the market for sales. And I think the cash component is definitely creating leverage amongst the sales because there's not a lot of mortgage deals taking place right now. They're very impacted by the rate hikes.
Francis, where is that? I guess who is buying? Because when you're focused on New York, obviously the average selling price in New York is extremely high when you compare it to what we're seeing play out in the rest of the country. So where is that demand coming from?
It depends on which area. I mean, you've got families that do need to upgrade, that do need to buy, and then you've got people who want to take opportunity while there's a lag in the market. The people that are buying are the people that have the means and the discretionary income to exercise it. To be honest, I mean, the outlier states are definitely feeling it. It's definitely flat for the spring season. But I think ultimately there are deals to be had. And I think that is basically what's driving it and the lack of demand. We are down 20.8% in inventory right now. And that's the cadence that's holding it.
Going back to Shauna's point, though, if you're talking about all cash offers here, I mean, are investors just kind of parking their money there?
It's twofold. I mean, I think the proliferation of cash is basically pushed forward by the lack of mortgage deals. And I'm not sure that it's necessarily more cash. It's just that the cash deals are becoming the prominent presenter. We're down on the cash deals anyway by 29%, but 65.4% of the deals that are closing are cash.
Francis, you mentioned
the average pricing, not the luxury sector, the averaging pricing right now is down at 1.2 million.
Yeah, but still 1.2 million, a heck of a lot of money, and certainly pricing out a lot of people who are looking for a home at this point. But Francis, you touched on something that really applies to almost everyone that is looking for a house right now, and that's the lack of inventory that is available. When it comes to New York, are you seeing any improvement along those lines, or what does the timeline for a potential improvement look like?
We saw a lag in inventory for April and May, which is usually a very strong season. And we're down for the first time in 11 years, year to date. So that's normally our big push for our inventory. I think that people were hoping to see more inventory hit during the spring market, but I think people are holding back because of the rate hike. People have to say goodbye to what they currently have, which is averaging 2.5% to 3.5% interest rates. And now we're seeing interest rates ticking just under 6% and a 30-year fix at almost 7%. plus. So I think that's the big dilemma of why we're seeing such a shape of lack of inventory. And the big question will be after the summer doldrum and we're back into the first quarter in September, the quarter of September, what we're going to see in terms of inventory brought back forward. I think everyone's trying to time it.
If we're talking about this from an investment perspective, how does New York City compare with some other major cities? If we're talking about the luxury market, I mean, how much more upside is there to be had in New York compared to some others?
I think New York by nature is a hub for investment. I think most people want to park their cash in New York, London, and Paris. So I think New York's always got the upper hand in terms of desirability for performance, especially from overseas. As it relates to the outer areas outside of New York, I think what we're finding is that although it's flat, we're still hearing about bidding wars taking place in Connecticut or in Texas. LA is still performing. It's not as the boom years of 2021 and 2022, but I definitely think that if the unit's priced right in any segment, you're going to have a complete bidding war because there's just not enough inventory because of what I mentioned before.
Francis, what is all of this doing to the rental market? Because I've seen the recent numbers here out of New York City, and it's extremely expensive. Over $4,000, I believe, the average price for a one-bedroom. How, I guess, do you see the lack of inventory, the fact that that situation might not improve anytime soon? What's that going to do to the rental market going forward?
I mean, it's going to tighten it up. I mean, I think even in November of last year, we were down in inventory at 2.7%. Right now, inventory has been spotty because I think the entry market was trying to get in. But because the rates started to jump back up, people couldn't make the numbers work. And so even though it was a 40% increase on the average rent from COVID times, it still was inherently better than trying to take a mortgage as an entry market buyer because it was too high. So I think what you're going to see is that the rental market's going to sustain a certain amount of strength, which I think is frustrating a lot of people who've been priced out.
Frustration certainly in the market there. Doug Zelman's, Francis Catton, good to talk to you today.
Thank you for having me. Bye.
Well, coming up, we are going around the horn and breaking down the latest trending stories. Josh Schaefer and Ali Canal standing by. What's on tap?
Hi, Kiko. Well, one story that we've been following closely was the PJ officials that showed up to Capitol Hill this morning.
And we got some more financial details on what that agreement looks like or could look like and how much money the Saudi Public Investment Fund might be giving to this new Gulf entity. We'll have those details next. Welcome back to Yahoo Finance Live. Josh Schaefer here with Alexandra Canal and Pras Subramanian. We're going through some of our favorite stories of the day, some of the top stories we've been following. And one story I was particularly interested in today was PGA officials in front of lawmakers on Capitol Hill to discuss the agreed upon merger, but not necessarily signed merger with LIV Golf, of course, the Saudi-backed LIV Golf League. And the exchanges today were quite interesting. I want to highlight one exchange to sort of kick off what the discussion was like today, guys. This was between PGA Tour Chief Operating Officer Ron Price and Senator Richard Blumenthal. Let's take a listen to what they had to say today.
We were in a situation of where we faced a real threat of...
But you could go elsewhere for $1 billion, $3 billion, maybe $50 billion, correct?
We could, but if we went down that path, we would end up giving up total control. But we would still face the threat of a $700 billion fund recruiting our players and operating a league in an irrational economic manner.
So again, that was Ron Price, the PGA Tour COO, filling in for Jay Monahan, who is still out on leave right now. But he was sort of laying out the case there of why they took or sort of sought out a merger with LIV and Saudi in the public investment fund instead of taking maybe private equity money, right? We know private equity has been increasingly interested in sports. And I thought it was interesting when he highlighted the amount of money the PIF has and essentially said, even if we got private equity money, if we got traditional U.S. funding, we still probably couldn't hang with the PIF and the amount of money they were spending on these contracts. Remember they offered Tiger Woods $700 million. Like, are you going to get private equity in the U.S. to be able to compete with that? And he coming out today and essentially saying, Pras, no way, right?
I mean, a lot going on here with a lot of testimony and documents submitted to the subcommittee. Like you're talking about, I think there was a letter between an intermediary of the PIF and Dunn, one of the members of the PGA Advisory Board, talking about how the Saudis were going to spend upwards of $5 billion to compete to try to take out the PGA, and that there was no way they could survive beyond that infinite kind of money chest, right? So I could see why the financial pressure was there on the PGA, but also hearing about how Rory McIlroy took meetings with PIF, with one of the people from PIF like earlier, and he's talking about how he had no idea this was happening, this deal was going on. He knew it was going down, right? So I guess there's a lot of like machinations behind the scenes there. What are we going to do with kind of like that's all interesting, but I think the two big parts that I think I was concerned about was the antitrust component and also the sports washing component, which I think is kind of a big deal that a lot of people were critical about.
And the antitrust part really wasn't covered that much.
That's what I was surprised about.
A couple senators talked about it briefly, but it really wasn't addressed that much. Now, the DOJ is also investigating that, so I think there'll be a separate hearing on that specific issue, but it really was not delved into that deeply, I didn't think.
No, and I was most surprised about that. I mean, to me, this entire hearing comes down to that soundbite that we heard. It comes down to the money. Money talks at the end of the day. And I do believe that the PGA probably wouldn't be able to continue to exist if they were always competing against LIV Golf, because that's what the money's behind them at the end of the day.
Well, Pras mentioned that potential $5 billion number, right? And it was interesting. A couple numbers came out through this process. The senators were doing a good job of asking questions about specific numbers. One that stuck out was that the PIF, the discussions have been for, quote, north of $1 billion to be invested in this new golf entity. Now, the PGA Tour, Price said, does about $2.1 billion in revenue. That's the expected revenue for this year. So about half of what they do in revenue coming into this new number. And then again, when you talk about the PGA Tour talking about their whole asset value today, Price said about $3 billion. So you're talking about $3 billion, and LIV maybe was ready to put in $5 billion.
Wow.
Like, it's just, there's no chance with the numbers these guys are playing with. And I think it's interesting also to highlight when we talk about this being golf and how different the scenario is than other sports. I think the PGA was in a very rare scenario here because they try and operate as a nonprofit. They're not funded by billionaires like some of these other sports leagues where you can get more money, get more funding easily and quickly. And so I think the PGA Tour got caught up pretty well. It was a nice play by the public investment fund to go after golf specifically if they wanted to get into American sports.
Right, because you can't really buy 30 NFL teams. Even the Saudis couldn't do that, right? I also thought it was pretty funny. I'm always harping on the funny parts about it, where when the PGA, once the PGA sort of got involved with PIF and talking about how this would work, talking about how they wanted to whack Greg Norman. I mean, all these are like, oh, but now what if we install our own guys in charge of this, and which they're going to do, right? But it's just funny how quickly they got, and not quickly, but how they were able to get yeah, we're going to take that money. I think we're okay with that. We're okay with that.
I think, Allie, the biggest takeaway here too, and I know you've covered, or another takeaway that you've covered as well, is the media aspect of this. And when you really think about what was happening at this hearing, I feel like a lot of just political posturing about talking about the money coming from Saudi Arabia, people, quote, being uncomfortable with it, people not wanting it, it's sports washing, et cetera. But at the end of the day, the money's still going to happen. So I don't know how that relates to what you've covered in terms of media deals, if there's still going to be a media deal, and maybe at the end of the day, in 5 years, people just kind of don't care where the money comes from, and you can still get media deals. That seems like
that's a
sort
pessimistic view, but it does make sense, because if you have something pulling in that money, like I said before, money is the thing that ends up talking. I do wonder, in terms of advertising, how that could potentially play into things if this merger is completed, if it goes through. Could certain companies pull out, not want to advertise for these tours? I'm not sure what the ripple effect is there.
I mean, I would say that golf has been a very friendly sport to sponsors, and people want to get their badging on
and it's a higher end consumer, right? Not a lot
financial
of
services, Lexus, car companies. Quickly on the antitrust stuff, right? Just quickly. So the NFL is the only, baseball is the only sport with an exemption, an antitrust exemption. They actually have that 100 years ago, like Oliver Wendell Holmes, Supreme Court justice made this ruling, right? But because of the fact that we're having this, I mean, there's no other major competitors in the pro golf game, right? The NFL has like what, USFL or whatever that thing was, XFL. There's nothing in golf, so it makes me think maybe there is an angle there for FTC just lost a big case today with Microsoft, Microsoft and Activision. Are they going to come after golf? I mean, I think maybe they might do that.
And then could they come after other sports then too, right? Because you look around and there's...
Well, it sets a precedent.
Well, they've always thought about attacking baseball's antitrust exemption, because why do they get that and the NFL doesn't, NHL doesn't, whatever else. So there's always that angle of the political and the kind of executive branch sort of thinking about what's going on here with sports. And then you're talking about nonprofit. I mean, really? I mean, a lot of questions there.
Always people making money in those nonprofits.
Right, exactly.
Well, speaking of companies and folks that are making a lot of money, there is a conference that I'm watching. It's out in Sun Valley, Idaho. It has a lot of influential people that constantly show up. We have David Zaslav, the CEO of Warner Brothers Discovery, as you can see on your screen there, Tim Cook, Bill Gates. And what's interesting about this conference is that it's very closed off to the media. We don't know a lot of what's going on. We don't really know the conversations, and that's because it has some stemming back to M&A deals and potential M&A deals that we've seen in the past. For example, if you take a look at the Disney Capital Cities deal from 1995, the Comcast NBCU deal of 2009, Jeff Bezos, Washington Post, all those deals trace their roots back to Sun Valley. And that's really interesting to me, especially considering the media environment that we're in right now. There's a lot of talk about what companies are going to sell itself, or at least parts of itself. We have Paramount CEO Bob Bakish showing up at this conference. Paramount has been a company that many have looked at as a possible acquisition target. He's already shopping around BET, according to reports. So I do think M&A is certainly a big topic of conversation, but we're also in this difficult operating environment.
I thought the M&A thing, just looking around at different suggestions, right? Sort of what's the rumor mill, who are people thinking could buy who, and having fun in that speculation realm a little bit on the internet today. I saw Paramount should sell itself. Maybe Warner Brothers Discovery could sell parts of itself. Zaslav could sell CNN. Would Bob Iger barter to spin off ESPN in some way or sell Hulu at this meeting? The amount of streaming stories and who should sell and who should buy and who should do what centering around this, to me, just speaks to the streaming space that you cover every day and how much people want or are looking for consolidation and trying to figure out what is actually the right move. I also think interesting to highlight that you see a lot of people now calling Netflix a buyer again.
Yes.
Like a year later, with that big run up in Netflix's stock, now all of a sudden we're talking about, oh, their balance sheet looks a lot better. Maybe Netflix will buy someone. Instead of someone a year ago, was someone going to buy Netflix? How that conversation has shifted in a year is pretty fascinating.
Yeah, I mean, well, the industry, the media industry is like in disarray right now, right? Bankruptcies, layoffs, all these. Not so much mergers, like who's going to buy little pieces of this? Who's going to take out CNN, right? Who's going to take out potentially something like I said, BET or one of these other smaller entities from bigger entities? I think it's kind of like up in the air right now. Don't ask. I mean, ask Zaslav how the big merger is going with Discovery and Warner Bros. I mean, it's kind of like up in the air right now. But so one quick thing, I just saw that Elon Musk is arriving on Saturday to Sun Valley. Zuckerberg's already there.
Cage match.
Maybe.
You
Is
know?
that what's going on behind the scenes at Sun Valley? Who knows?
I mean, maybe Iger will hop in there and kind of like referee
This would
it.
be the deal of Sun Valley, right? Is what streamer barters to get the rights to stream it.
You heard it here first, folks.
That is the $1 billion deal you could make at Sun Valley if you can stream the Zuck Musk cage match.
Michael Buffer, maybe? No.
100%. Yeah, but just to close, media industry very fragmented. All the things you guys said. There's a lot of cost cutting, and in the background you have a writer strike. SAG-AFTRA contract expires tomorrow at midnight, so these actors could be joining the writers for that strike. A big topic of conversation here is AI and the focus of AI. So I do think artificial intelligence, the role it plays in media and a lot of these tech companies, is also another big topic of conversation at Sun Valley.
So a lot to watch, a lot of drama there in Sun Valley. Maybe a Musk and Zuckerberg sort of link up there. We'll see. More Yahoo Finance after this.
Shares of Activision closing the day higher after a federal judge has paved the way for Microsoft to acquire the video game giant by declining the FTC's request to block that $69 billion deal. Let's bring in Michael Pachter, Wedbush Managing Director, Equity Research. Michael, on the back of that ruling here in the U.S., we saw the UK say it's pausing its litigation. Does this pave the way for full regulatory approval globally?
I doubt that you get full regulatory approval. I think the CMA continues to do its best to block the deal, but it looks like Microsoft has reached an accommodation with the UK. So the UK sticking point was that it was concerned about Activision games being on the Microsoft streaming service called Game Pass. They had conditionally approved all the console, PC, mobile side of the business, which is 95% of the business. So I think that carve out there satisfies the UK, and then Microsoft can appeal that decision, and it might take a year or two to get streaming games, Activision games on streaming in the UK. But really, it's a tiny, tiny impact on the deal. So yes, 99% approved with that one small exception.
Michael, how do you think investors are looking at that carve-out that we could see for the UK? Is that something that they will be fine with, given the fact that it is just a small percentage of their business?
Yeah, Microsoft has 25 million subscribers. that pay, call it $15 a month, so $180 a year. So that's $4 billion. The UK at most is 1/6 of that. And there's no way anybody's quitting because Call of Duty isn't going to show up on Game Pass in the UK. In fact, if there's an investment opportunity, I would invest in Irish VPNs because the UK consumer who wants to play Call of Duty will just pretend he's in Ireland, and the EU has already approved the deal. But revenue-wise, negligible impact, almost zero.
Michael, when you look at the stock move today on the back of this Activision getting a bump of roughly 10%, I mean, how much of that do you think is justified? Because you go back to the original announcement of the deal, was seen as a big bump for Microsoft as they try to add to their mobile offerings in gaming. I mean, give me your assessment as it stands right now for both of these companies.
Well, the market was really pessimistic about the deal. It was announced in January of 2022, so a year and a half ago. And the market thought that the FTC was going to be intransigent and dig its heels in and win. The problem, I think, with that view is that it presupposed that Microsoft would pull all the games off of PlayStation. And Microsoft started saying from the outset that they would support PlayStation. They, in fact, offered Sony a 10-year deal. They signed a 10-year deal with Nintendo, and they offered the same terms to PC service and to NVIDIA. So once that was out of the way, maintaining the status quo, the only sticking point is whether putting Activision's content on the streaming service is unfair to the consumer. And even the UK, who blocked the deal on that, said it's actually good for the consumer. We're just concerned they'll raise the price of Game Pass. So ultimately, the market was wrong. They thought that the government could stop any deal, and the judiciary is just not corrupt. I don't care what people say. The judiciary kind of tends to rule based on what the law says, and the law here was pretty clear. If Microsoft maintains the status quo, the consumer isn't hurt. And if the consumer isn't hurt, there's no basis to block the deal. And that's exactly what happened this morning in the district court.
Michael, this ruling certainly is a blow, I think it's fair to say, to the FTC. And we know the FTC had been aggressive or wanted to be aggressive in cracking down on these very large acquisitions. What do you think this does for companies thinking about future deals? Is this going to be enough confidence for these companies to come off the sidelines and maybe execute on some of these deals that they have been waiting on the sidelines with?
I think the signal here is, the FTC is going to try to object to any deal done by any, Fortune 10 company. So Google and Microsoft and Apple and Amazon, anything they do is going to be scrutinized. This one, the law just was on Microsoft's side. And, if you think about it, Microsoft's a nearly $200 billion revenue company and Activision's an $8 billion company. So this is Goliath, buying David. It's not Goliath buying Goliath. And, so I think that you'll still get scrutiny of giant deals where, there's monopoly power. But this one just didn't move the needle in the games industry. The FTC has to have a basis for its objection other than we don't like big tech. And I think this puts them on notice that the courts are not going to side with them if that's the reason that they object.
So certainly this is going to be assessed on a case-by-case basis, but does it at least remove some cloud on those concerns about regulation? I mean, to your point, you're saying this is not sort of big tech versus big tech coming together, but the FTC has been aggressive in many of these deals, and the concern has been that they would really stop any type of M&A activity. Now, at least, they've suffered a big blow on this particular one. As an investor, how do you assess that?
The FTC just doesn't like the big getting bigger. And, if it's a situation where an Amazon decides to get in a grocery and buy Whole Foods, I just don't think there's any basis to object to that back when it happened. If there's a situation where Amazon decides it doesn't have any capability to make movies and it buys MGM, no basis to attack that. The deals that should probably get blocked under this FTC are the Disney Fox acquisition. That's a tough one because that's, a big studio buying another big studio. T-Mobile, and Sprint, that's a big telecom buying another big telecom. And so I think that they're going to look at the big stuff But honestly, when Facebook buys a little VR developer, they objected to that and they lost. And they lost this one. They've just got to start picking their battles. There's a reason that criminal prosecutors have a 98% conviction rate. It's not because everybody's guilty. It's because they try the cases that they have winners on. And so the FTC has to start behaving like a prosecutor and only pursuing the cases that they know they have a winner on. This was a loser from day one. They blew it on this one. And I hope that they learn their lesson and they stop going after companies that are really not breaking the law.
We will see if the FTC is a little bit more selective in some of the cases that they bring forward in the future. All right, Michael Pachter of Wedbush, thanks so much.
Thank you, Sean.
Well, coming up, it's closing time here on Yahoo Finance. We will recap some of today's top stories and get you set up for everything you need to know tomorrow. Stay tuned.
It is closing time here at Yahoo Finance Live. Here's a look at some of the top stories of the day. Microsoft's deal to acquire Activision Blizzard now one step closer to completion. A U.S. judge ruling against the Biden administration, saying the FTC did not show the deal would hurt competition in the console for the cloud gaming market. And across the pond, the company's getting a reprieve from UK regulators. They are now going to pause their investigation to allow time to negotiate with Microsoft.
Bank of America, the latest bank hit with a major fine over fake accounts, junk fees, and other issues. The bank set to pay $250 million to settle claims that it double-charged customers' fees withheld promised credit card perks, and opened accounts without customer authorization.
And Elizabeth Holmes is set to be released from prison earlier than expected. She started her 11-year sentence just about 6 weeks ago. According to the Prison Bureau website, she is now set to be released after 9 years behind bars. She is now scheduled for release on December 29th, 2032.
All right, well, that does it for us today on Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.